Jeff Bezos often gets a bad rep as the evil bald dude behind Amazon. People often accuse him of reaping the benefits of his laborers' work, suggesting that he doesn't deserve the wealth he has accumulated. Though Jeff Bezos may not put in as many hours as his employees today, he has taken on extreme financial risks in the past before making it big, and at many points throughout his journey, things were looking quite bleak. So, here's the story of how Jeff Bezos lost 90% of his wealth in less than 2 years. Starting off, throughout the 1980s and early 1990s, computer technology was rapidly advancing, which allowed for lower entry prices and faster adoption than ever before. This, combined with the launch of the first couple of generations of Windows, made using computers a practical task for the average person. As a result, computer and internet usage was growing in the thousands of percent per year. In fact, this would be the main reason that Jeff Bezos would quit his cushy job at a hedge fund and decide to start Amazon. He describes that internet usage was growing at 2300% per year, while he was over here at a hedge fund banging his head against a wall trying to get 10 or 20% annual growth figures. With that, Jeff Bezos would start an online bookstore named Amazon in the year 1994. This would turn out to be really good and really bad at the same time. You see, it wasn't just Jeff Bezos that was anxious to enter the online game, but so were investors. Throughout the 1980s and early 1990s, the boomer generation of the time often wrote off computers as another fad that would die off sooner or later. However, Bill Gates would destroy this notion. In 1995, Bill Gates would become the richest person in the world at the age of just 40 years old. More importantly, Bill Gates' rise had little to do with speculation and guessing. Microsoft was strongly profitable from the day they went public, and over the years, they had simply grown their dominance and profits. So, Bill Gates had become the richest person in the world using tech legitimately. Aside from this, several other successful tech companies were starting to pop out around the same time, like Cisco, AOL, and Oracle. But just because these were so successful didn't mean that the internet and computer space were an automatic goldmine. Despite that though, the people who had missed out on the historic growth of these companies were obviously not very happy. Many of these guys, whether large hedge fund managers or your everyday millionaires, were determined to catch the next Microsoft. And this is where things started to go downhill. Or I guess, uphill. Microsoft enjoyed strong stock growth because they had strong control of the market and even stronger financials. But this wasn't exactly the case with most companies entering the tech scene, including Amazon. These up-and-coming tech companies boasted large revenues and user growth year after year. However, their bottom line was often heavily in the red. Venture capitalists and retail investors didn't really care though. This might sound irresponsible, and it is, but there was some reason behind the madness. It's not like investors were pouring all of their money into one tech startup and hoping for it to blow up. Rather, venture capitalists were of course hedging their bets, pouring money into hundreds of tech companies, knowing full well that most of these companies would go nowhere. That didn't matter though. They just needed one of their hundreds of investments to become the next Microsoft, as that would more than make up for all of their losses. Considering this, these investors would bid up the stock of essentially all the tech companies they could find. Meanwhile, Jeff Bezos thought that it was a good idea to take Amazon public in 1997. Though they were facing big competition from Barnes & Noble at the time, Amazon had extremely promising statistics. In just the year preceding their IPO, Amazon managed to grow their user base 5.5 times, from 180,000 customers at the end of 1996 to 1 million customers in October of 1997. Concurrently, their revenues were growing even faster. In 1996, they enjoyed 15.7 million in revenue. This exploded to 148 million in 1997, and by the end of 1998, they reached a whopping 610 million. Evidently, Amazon easily had the growth numbers to beat a quote-unquote next Microsoft, which led to investors eating them up. Starting with an initial price of $18 per share, Amazon stock would skyrocket between 1997 and 2000. In fact, their stock would grow so fast that Amazon would complete 3 stock splits within just a 1.5 year time frame. The first stock split was a 2-to-1 split in June of 1998. This would be followed by a 3-to-1 split at the start of 1999. And later that same year, Amazon would complete another 2-to-1 stock split in September of 1999. With all of these stock splits, each original share of Amazon would be worth 12 shares. Even with these splits though, Amazon would sport a share price of $92.31 in January of 1999. If Amazon had never split their shares, that would be the same as a share price of $1,107.72. Let's keep in mind that just 1.5 years before this, Amazon was worth $18 a share. I tried using a return rate calculator on this growth, and the calculator straight up told me, please use reasonable numbers. So, I did the math myself, and Amazon's return on investment over those 1.5 years comes out to 6,054%, or about a 1,400% return annually. To put this in perspective, let's take a look at Tesla stock. You guys might think Tesla stock has gone crazy since November of 2019, and it has. But to match the growth of Amazon stock over those 1.5 years, Tesla would have to reach a share price of $3,700 by May of 2021, or a pre-split price of $18,500. Clearly, Amazon no doubt experienced some above-average returns throughout the late 90s. Despite their success on Wall Street though, Amazon was juggling a variety of significant issues. For starters, they were going through a legal mess. In 1997, Barnes & Noble would sue Amazon for claiming that they were the largest bookstore in the world. Barnes & Noble argued that though Amazon might have the largest catalog of books in the world, they didn't have any retail locations, so they weren't really a bookstore at all. In retaliation, Amazon would accuse Barnes & Noble of tax evasion in states where they had stores. According to legal experts, this move from Amazon was, quote, brilliant. Looking back though, this is quite ironic, as Amazon would end up being the company that is infamous for undercutting taxes. Anyways, as neither company really wanted to deal with these accusations, they would come to a settlement later that year. But just as this drama came to an end, Walmart would decide to sue Amazon in 1998. Walmart would accuse Amazon of recruiting former Walmart employees to uncover trade secrets, and this lawsuit would drag on for a couple of years. In the meantime, large amounts of capital was still flowing into Amazon, which eased the financial burden of growing the company while dealing with these lawsuits. However, all of this would change at the turn of the millennium. No one really knows what caused the dot-com bubble to burst starting in early 2000, but here are some factors that likely played a role. First of all, there were a lot of early investors in the dot-com hype companies. I mean, it wasn't that hard to be early. You didn't have to call the company's growth 10 or 15 years before it actually happened. You just had to bet some money on the internet a few years before everyone else, and you would be up tens of times on your money. Considering this, these early investors likely started to take profits. At that point, they had already caught the next Microsoft. Sure, the business side of the company wasn't quite there in most cases, but the stock growth was already there, and oftentimes it was even greater than that of Oracle and Cisco and the other classic tech companies with strong fundamentals. Thus, it made sense to take some profits off the table. Generally, this should have little effect on the overall stock growth of the company, as if a company truly has strong fundamentals, new buyers should flood in as early investors get out. But as we know though, none of these valuations were built off of a strong foundation. Something else that may have caused the downfall is that the majority of people feeling FOMO in the late 1990s had already got in. Thus, there was no one left to buy the stock for even higher prices. The combination of these two factors, and likely several other driving forces, led us into a series of negative feedback loops. As the stocks of tech companies started to dip, instead of new buyers looking to buy the dip, early investors were starting to get more fearful. Maybe it was time for them to lock in some profits as well. This in turn introduced greater selling pressure into the market, and the pattern repeated a couple of times until we entered a full-fledged sell-off. Consequently, Amazon stock would crumble from their peak of $106.69 in December of 1999 to $5.97 in September of 2001. Considering that virtually all of Jeff Bezos' wealth was tied up with Amazon stock, just as it is today as well, his net worth would get slashed from a little over $10 billion at the peak of the bubble to $1.2 billion at the bottom. Now, of course, this means that he never lost the title of billionaire throughout the fiasco, and most of us would be thrilled to have just $1 billion. However, I'm also quite confident in saying that most of us would feel awful if we tumbled from over $10 billion down to just $1 billion within 2 years. Despite this terrible turn of events, Jeff Bezos would continue trying to make Amazon profitable, and he would be successful in the fourth quarter of 2001. At the same time, he also worked on diversifying the business by launching AWS, which to this day accounts for the majority of Amazon's profits. Slowly, over the years that followed, investors would realize that though Amazon was likely very overvalued during the dot-com bubble, the company did actually have strong fundamentals and a bright future. Consequently, nearly a decade later, this positive outlook would allow Amazon to cross its dot-com high during late 2009. And since then, Amazon has been on a roar, growing past $3,000 a share from just $6 in 2001, allowing Jeff Bezos to be one of the richest men in the world. What do you guys think about Amazon's valuation today? Do you guys think it's overvalued, or do you think there's plenty of growth left? Comment that down below. Also, drop a like if you guys thought this video explained Amazon's rough ride through the dot-com bubble well. And of course, consider joining our Discord community to suggest future video ideas, and consider subscribing to see more questions logically answered. But until then, I'm Hari, and I'll see you guys on the next one.